Hello? We simultaneously analyze the real estate market and macro trends in capital markets. This is Build Lab Archive Global, delivering investment insights from experts holding qualifications as architects, licensed construction engineers, and masters in real estate development. You ever heard of a business book that's so rare, so in demand that people pay thousands of dollars for a used copy? Well, today, we're cracking open that very book to look at the secrets of its author, the legendary investor, Seth Klarman. So this is it. This is the book at the center of it all. Margin of Safety, Risk-Averse Value Investing Strategies for the Thoughtful Investor. It was published way back in 1991, had a really limited print run, and then just vanished from the shelves. But its legend? So, its legend just kept growing, becoming this almost mythical text for the world's most serious investors. And that legend, it comes with a pretty wild price tag. If you can even find a copy today, you're probably gonna pay over $2,000 for it. I mean, think about that. That's more than a lot of people spend on their first car for a 30-year-old paperback. So, what is the big deal here? What secrets are hiding in these pages that make it one of the most valuable finance books on the entire planet? All right, let's dive in and find out. To really get this book, we have to start with a huge distinction that Seth Klarman thinks is the root cause of most financial blowups: the difference between investing and speculating. See, Klarman's whole argument starts here. Most people who think they're investing are, in reality, just speculating, and that little mix-up, he says, it's a recipe for absolute disaster. Okay, let's break this down for a real investor. The return comes from the asset itself. You know, like the profits a company makes. But for a speculator, it's all about hoping the price goes up because of market buzz. Their focus is totally different, too. Investors are digging into business fundamentals, trying to figure out what something's really worth. Speculators are looking at charts and trying to guess what everyone else is thinking. It really all boils down to the question you're asking. An investor asks, what is this business actually worth? While a speculator is just asking, what will some other person pay me for this tomorrow? Klarman tells this brilliant story to make his point. So sardines vanish from Monterey, right? And the price of canned sardines just shoots through the roof. Traders are making a killing, just buying and selling cans to each other. Then one day, a buyer actually opens a can, takes a bite, and it's disgusting. He complains to the guy who sold it to him, and the seller just says, "You don't understand. These aren't eating sardines, they are trading sardines." And that right there is speculation in a nutshell. All right, so once you've decided you're going to be an investor, not a speculator, you need a North Star. For Klarman, that principle is so important, he named the entire book after it. Let's get into the heart of his philosophy. The margin of safety. To put it really simply, the margin of safety is like buying $1 for 50 cents. It's that discount, that gap between what something is actually worth and the price you pay. It's your buffer. It's your cushion. It's your shield against the world that you just can't predict. And what's so interesting about Klarman's whole viewpoint is that he's not just trying to get a good deal. He's admitting that the future is a mystery. Your math could be wrong. Bad luck could strike. The world could go totally haywire. The margin of safety is your protection against the one thing you can absolutely count on: uncertainty. Now, the process sounds simple, but trust me, it's not easy. First, you do the really hard work. of figuring out a business's true underlying worth. Then step 2, you look at the price. The emotional, often kind of crazy market is asking for it. And then step 3, you only, and I mean only, pull the trigger when that price is way below the value. You just wait for that perfect pitch. Okay, this all sounds great in a textbook. But how does it work when the world is ending? Let's go back to the fall of 2008. The entire global financial system is teetering on the edge of collapse. Panic is everywhere. People are just dumping assets, selling anything they can. And while almost every investor on earth was panicking, selling at any price just to stop the bleeding, Seth Klarman was calmly doing the exact opposite. He was putting money to work at a staggering rate, sometimes investing $100 million in a single day. He wasn't trying to guess the bottom. He just saw that prices had fallen so far below their real value that his margin of safety was absolutely enormous. So how did he do that? Seriously, how do you buy when every single human instinct is screaming at you to sell? Well, this gets us to what Klarman thinks is the single biggest roadblock in investing. And it has nothing to do with spreadsheets or finance. It has everything to do with you. Klarman's point is that the hardest part isn't finding good investments. It's getting a grip on your own emotions. We are literally hardwired to run with the herd, to panic, to get euphoric, and all of those things are poison for long-term returns. To really succeed at this, you need a pretty rare set of character traits. You need the patience to sit on cash for years, just waiting for the right moment, the discipline to stick to your homework when everyone else is chasing some hot new thing, and the emotional control to get greedy when others are terrified, and just as importantly, fearful when everyone else is greedy. So if you manage to get the mindset right, where in the world do you actually find these amazing bargain bin deals? Well, Klarman has a very specific playbook for digging up these hidden gems. Here's his secret. It's not just about finding undervalued companies. It's about finding situations where huge institutions are forced to sell no matter what the price is. He's basically exploiting the rigid and sometimes dumb rules of the system itself. He is a master of financial dumpster diving. I mean, think about it. When a stock gets kicked out of a big index, like the S&P 500, all the index funds, we're talking trillions of dollars, have to sell it immediately when a company spins off. A small division, big funds often just dump the new stock because it's too tiny for them to bother with. When a bond gets downgraded to junk, some insurance companies are legally required to sell it. These are forced sellers, and they create the absolute perfect hunting ground for value investors. So, after all that, what's the big lesson? What's the ultimate takeaway from this $2,000 book? Well, it's about something much bigger than just stocks and bonds. The real margin of safety is a mindset. It's a way of thinking, a framework for getting through a really complex and unpredictable world. It's about building a buffer in all the parts of your life, your career, your health, your relationships, by always thinking about the downside before you start chasing the upside. So if you take away anything from all this, let it be these 4 key ideas. First, the best way to win in the long run is to focus on not losing. Second, the crowd is a terrible guide when things get really scary or really euphoric. Third, your most powerful tools are patience and cash. And last, but maybe most important, never ever confuse the price of something with its actual value. And that really brings us to the final thought here. The ideas in this book didn't just help Seth Klarman survive the 2008 crisis. They helped him build one of the greatest investment track records in history. But the real question for all of us is a lot bigger. In a world that feels more volatile and uncertain than ever, where can you build a bigger margin of safety in your own life? For more details, please refer to the pinned comment on our blog. Thank you for watching.